To put it simply, you buy a call option when you think the stock price will go up by the expiration date. You sell a call when you think the stock price will remain the same or go down. A buyer of a call option pays a premium to buy 100 shares of a stock at a fixed price by a later date, which is the expiration date. A buyer believes that the price of the underlying stock will go up within the time frame of the expiration date and wants to lock in the price at which he or she can buy the underlying stock at. A seller of a call option is on the other side of the equation. The seller receives a premium to have the obligation to sell 100 shares at a fixed price by a later date. The seller of call options wants the price of the stock to remain the same or go down so that the option expires worthless and the seller gets to keep the premium paid by the buyer. Now let's break down what's happening here with an example. First, let's understand what's going on here in the first line. The AAPL represents the ticker symbol of Apple, the company. The 205 is the strike price, meaning the call buyer believes that the price of Apple will be more than $205 by the expiration date of April 18th, right here. The C represents call, which is the kind of option we're dealing with here. Okay, now let's say Apple is trading at $200 today, but you think the price of Apple stock is going to jump up in the near term. Maybe they're releasing a new iPhone, maybe they're announcing earnings in the coming week, or maybe you expect some good news coming out of the trade deal. Let's say you expect the price to jump to $210 by the end of the week. In this case, you would buy a call for a strike price of, let's say, $205 with an expiration date of next week, which is what we have here. Meaning you're paying a fee today of 60 cents per share or $60 overall to have the right to buy Apple for $205 at the end of next week, when the actual price of Apple stock could be $210 or even higher. If Apple actually ends up jumping to $210, you'll be making a profit since you have the right to buy the stock for only $205 and the market is currently trading at $210. If the price of Apple stock falls below $205 by the expiration date, your option will expire worthless and you will lose the $60 that you paid as a premium. This little image below shows the breakers in 60 cents. The buyer makes money if Apple closes above $205.60 and loses money if Apple closes below $205.60. Remember, you always have to account for the premium paid when calculating profit and loss. Now let's look at this from a seller's perspective. The seller of a call option is on the other side of this trade, and the seller's incentives are opposite to that of the buyers. A seller of a call option wishes for the options contract to expire worthless so that they can pocket the entire premium that the buyer has paid. It's important to note here that the seller receives the premium regardless of the stock price at expiration. In this Apple example, the seller of the call hopes that Apple closes below $205, which is the strike price of the call option. If this happens, the option expires worthless and the seller keeps the $60 as profit. The seller would break even if Apple closed at $205.60, since the seller received $60 to sell the call. If Apple closed above $205.60, the seller would lose out on potential gains because they're forced to sell the stock at $205 even though the market would be trading it way higher. For example, if Apple indeed closed at $210 a share, the seller would still have to sell his or her 100 Apple stocks for only $205, thus losing out on $500 worth of additional income. The graph below again shows the profit and loss for a seller, which is exactly the opposite to that of a buyer.